All right, you guys. So my name's Mark Munoz. I'm a mortgage broker and relationship banker at MG Capital. Kareem's been a longtime client of ours, and he's arguably one of the biggest. Has a couple hundred units. So he asked us to kind of step in and talk about DSCR loans and some of our other products a couple weeks ago. And so over the course of the past couple weeks, we've been preparing a curriculum that we can kind of give to our clients who he's going to be referring over to you guys, just for you guys to see what exactly a DSCR loan is, and then how to utilize some of the financing structures that become a little bit more intricate, that are not necessarily super in vogue or very popular with a lot of real estate investors. And so the general outline for this curriculum, and we're taking this very seriously, by the way, because we do think that real estate investors are pretty underserved with the sort of financial products that they get access to. And so the general structure of what this is going to be is we're going to first talk about DSCR loans from a high level. What is a DSCR loan? What's required for approval? How to get pre-qualified? What to expect from the mortgage process? What is a processor? Etc. Things like that. Things that you can take with you even if you don't work with our company that are beneficial for you to know. And then, we'll talk about minimum purchase prices, best practices, property specifications, rates and fees that are specific to us and our programs. Then we're going to talk about working capital. What is working capital? How we originate working capital? What docs are required for approval? How to get started? What to expect from the process? Processors in working capital? What is a CPI sheet? Credit optimization? Things like that. And then finally, we're going to get into the meat and potatoes of what I think is going to really drive a lot of value for you guys. Again, whether you work with us or not, which is this: what is a capital structure, what is a capital stack, why does it matter, and how in particular to combine DSCR loans and working capital loans to scale. And a lot of that comes down to creative financing structures. You must watch the capital structure module to get access to the creative financing strategies. And so that's sort of high level what we're going to talk about. It's going to be a couple hours long, but this first one is going to be about DSCR loans, and we're going to talk about the curriculum behind DSCR. It's just going to be a practical guide to understanding and applying debt service coverage ratio for smarter financial analysis and decision making. All right, so section 1, what is a DSCR?
Before you start, can I say something? I gotta tell you guys, okay? It's 10:27 p.m. right now, and this is what you want to see from a managing partner. I'm sure Kareem Soon is going to appreciate you more.
Just got to make sure that the clients are getting served. So section 1, what is a DSCR loan? DSCR loans are really a type of real estate loan that's underwritten primarily based on the property's cash flow. So you'll see this concept of DSCR be applied to transactions outside of real estate. You want to think about DSCR as a number in and of itself. The ratio in particular, you want to think of it as sort of a credit score for the transaction's ability to cover its debt obligations. And so really what it is, DSCR is a measure of the transaction's ability to meet its debt obligations. It's just a measure of cash flow, kind of. Whereas, a 1.0 DSCR is going to be the cash flow meets its debt obligations 1-to-1. So it makes enough cash to pay for its debt obligations, but doesn't make anything left over. That's why you'll see a lot of mortgage lenders require a 1.25 or 1.5 DSCR for approvals. And then some mortgage lenders can do negative DSCR. We can do negative DSCR. And so, some people can go to 0.75, and then other investors want to underwrite transactions to just meet 1.5 or 2.0 DSCRs. That's just going to be a measure of the transaction's health, financial health. So again, it's a measure of the property's ability to cover its debt obligations. Pretty much the most important thing to know about DSCR loans is that they do not impact your debt-to-income ratio. We're going to get into this topic a little more, but that's the primary thing to know about why they're important to scale. The reason why DSCR loans are important and why they matter to you as a real estate investor is because they don't impact your debt-to-income ratio. That's pretty much the primary takeaway here. Even, I know we're on the first slide, but that's really going to be the primary takeaway. Why you would use a DSCR loan over conventional boils down to conventional loans are going to impact your debt-to-income ratio. DSCR loans, on the other hand, are not. So DSCR loans do not limit your future ability to borrow, whereas a conventional loan, on the other hand, is going to leave that mark on your debt-to-income ratio, take up some of that space, whereas in the future, if you want to start a business, if you want to get into a home, buy an expensive property, maybe for a wife and kids, the conventional loan is going to impact your ability to borrow in the future, whereas a DSCR loan is not. So it's limited strictly to investment properties, does not impact your debt-to-income ratio. So there's no hypothetical cap, there's no theoretical ceiling to scaling. So again, just moving on here, we're going to zoom out and treat DSCR not necessarily as a real estate metric, kind of how I was talking about a second ago. We're going to mainly treat it as a corporate finance underwriting concept that's been adapted to property lending. That's basically what's happened with how DSCR loans have become popular. DSCR is really a concept in business finance, corporate finance, that's been adapted to real estate. And so its original business context, again, is really just being used as a measure of the company's cash flow and its ability to meet its debt obligations. So this is going to be your DSCR formula. In the business world, we have a thing called EBITDA, earnings before interest, taxes, depreciation, and amortization, whereas a real estate investor would call it net operating income, NOI, divided by PI. That's going to give you your DSCR, and that's going to be a pretty good metric to determine the transaction's ability to cash flow, right? So, again, we're talking about this a little bit earlier, but if the DSCR is greater than 1, then it can meet its debt obligation safely, and the higher above 1, the better, whereas the lower below 1, the worst, okay, because you're going to be underwater and it's going to be close to bankruptcy. So banks use this as a test for solvency and repayment capacity. It's a very forward-looking measure of whether the enterprise can sustainably handle leverage. As we adapt DSCR to real estate investors usually face the same basic question: can the property's operations pay for its loan? I was talking about this a second ago. In the business world, a lot of bankers will look at EBITDA. How many times does EBITDA cover? How many times does cash flow cover debt service? So in that sense, EBITDA is going to be your measure of cash flow. Whereas in real estate, it's going to be NOI as your measure of cash flow. You don't really want to use gross rent. You want to use your NOI. So DSCR has kind of transitioned out of the boardroom into the world of real estate as now a tool for real estate investors to use to scale. So again, I was talking about this a second ago, but the primary reason why DSCR loans are going to be useful to you more than a conventional loan is because DSCR loans detach the underwriting process from your personal income and tax returns to instead just having a singular focus on the property's ability to perform, right? The actual DSCR ratio itself. And so that's what this sentence is talking about. A lot of talking heads on the internet like to talk about DSCR loans as like, this willy-nilly loan that you can get approval through pretty much regardless of anything, regardless of your credit. That's not necessarily the case. It's not a subprime loan in any means. It is just a good test for creditworthiness. It'll gauge the transaction's creditworthiness without having to look at the borrower too much. A lot of banks are still going to look at like a minimum credit score requirement, and that'll depend from bank to bank. But really, there's a big focus on the property itself. DSCR as a concept should really be treated really like a lens more than anything for you as a real estate operator. For us, right, and for a lot of other banks, there is not really a specific DSCR ratio that you need to meet. For us, you can be negative, right? I kind of touched on that a second ago, but you want to use DSCR, the ratio itself, as a measure of the property's ability to perform. So the higher the DSCR, the more likely it is that you get into that transaction, whereas the lower the DSCR, maybe, you want to steer away from that deal. Okay, so moving on here. Typically, in the business world, there's covenants on DSCR based on the ratio itself, right? So, for example, if you're financing a deal as a banker and the DSCR dips below 1.2, 6 months into the deal, there is going to be some covenant typically where maybe you can call the loan. That's not the case in real estate, so you don't necessarily have to worry about that. But the reason why that matters, this is, I want to keep drilling this home. The reason why this matters is because DSCR is going to be, you can think of it as the deal's credit score, right? So going into the deal, if the property's DSCR is a 1.5 or a 2, then that's going to be a deal that's worth getting into, that's safe. You can treat that as like your margin of error. Whereas, if you have a negative DSCR, even if the lender is going to approve it, you would kind of want to think twice about getting into that transaction, only because that property and that deal are pretty much going to hinge on doing a turnaround, right? Maybe installing more tenants or getting a higher occupancy rate that's kind of going to be what the deal hinges on. So again, the higher the DSCR number in and of itself, the higher above a 1 it is, the better. Okay, so next we're going to talk about what docs are needed for a final approval. We figured that we'd kind of give you guys, this is going to be based off of an internal document of what you're going to need to submit before you get into the underwriting process. A lot of banks like to catch borrowers off guard and say, this is a no-doc program, and then, 3 days into the financing process, you're ordering the appraisal and they ask you for 20 documents. That's not what this is going to be. So we want to give you guys our internal list of every single document you might need to submit to get a final approval in underwriting through us. So that's going to be valid ID and social security card, 2 months of your most recent bank statements, credit report, tri-merge. So we're going to look at all 3 bureaus. We need a holding company, LLC, operating agreement, articles of organization, and an IRS issued EIN letter. So we need that for the holding company, and we're going to need that for the operating company. If you have a holding company and operating company structure where the operating company is owned by the holding company, we're going to need all docs for both. So that's going to be borrower and entity documentation. For property and transaction docs and other things like that, we need a loan estimate to be signed by you guys. You guys will be issued that by your loan officer. And internally, loan officer is going to prep a loan sizer, and we're going to need to collect bank-issued wire instructions or a voided check from you or on your behalf. Besides that, we're going to need fully executed purchase contract, appraisal report including any cost to cure repairs, plus the paid invoice of the appraisal report and the compliance certificate from the appraiser themselves. We're going to need an insurance quote and an insurance declaration page. We're going to need from the title company EMD receipt, tax certificate, title commitment, closing protection letter, E&O insurance, 24-month chain of title, preliminary closing disclosure, and a survey exception confirmation plus wire instructions just to know where to send the money. What does all of that mean for you? Because that was a lot of jargon. Believe it or not, that's pretty minimal in terms of paperwork. So you're really just going to be submitting bank statements and LLC documents plus ordering the appraisal. Beyond that, we're getting a lot of the docs from the appraiser, the title company, and your realtor. So minimal paperwork burden. You're not scrambling to dig up tax returns from 2 years ago. It's deal-driven underwriting. Again, we talked about the DSCR ratio as a concept at length, so hopefully you guys understand it. It's really based on the property itself, and then investor-friendly closing. Most docs are supplied by third parties, like I said, so realtor, title company, and appraiser. That's where the majority of the docs in our deals we're going to be collecting, and we're just getting the bank statements and LLC documents from you. Credit pulls are minimal, so I mentioned the tri-merge that we have to get. We do need that tri-merge, but we only have to pull your credit once every 90 days. So hypothetically, we do a credit pull on January 1st. You have 90 days to buy 1,000 properties, and we don't have to keep pulling credit pulls on you. We can just use that same one that we pulled. It's good for 90 days. So that's what this slide talks about. It keeps the process smooth. We don't have to keep dinging your credit anytime you send us a new deal. We just do it that one time, and it's good for 90 days. So next, how to get pre-qualified. All right, so we're going to be talking about how to get pre-qualified now tactically. So what docs you need. I guess, taking a step back. What a DSCR loan is. Why they're good. What the ratio means and why it matters. And then how to utilize that ratio in doing your own property underwriting for yourself to know if a deal is worth getting into or not. What documents we need to actually get a final approval, who we're getting those documents from, and so next we're going to talk about how to get pre-qualified so you guys can begin submitting offers on deals to get started, right? Because we want to scale up the portfolio and get more properties. So how to get pre-qualified. We only need 7 documents from you to issue a pre-qualification letter, and typically that pre-qualification letter goes out within 24 hours. So you submit driver's license, proof of primary residence, and your 3 LLC documents for your operating company. That's going to be the LLC that you're going to use to buy properties. So if you're going to be buying properties, for example, in Florida, it should be a Florida LLC. This is not going to be for your holding company. This is going to be for your operating company. We need the articles of organization, we need the operating agreement, and we need an IRS issued EIN letter plus 2 months of bank statements. So we have a pretty short pre-qualification form. It's 7 documents, and then boom, you'll get a pre-qualification letter back that same day or the next day. So the way that it works, we have it on a type form. So it's very smooth, really clean, really neat piece of software. It's great. I love using it. All of our borrowers love using it. It's clean, it's smooth, it's really neat, it's great software. You submit the 7 documents. They're linked in Kareem's platform. So you just submit the 7 documents, boom, click submit. You can get through it in about 5 or 10 minutes. It's really quick. And then within 24 hours, you're going to be getting back a pre-qualification letter. Could even be same day, just depending on how busy we are. But you'll be getting back that pre-qualification letter, and it's going to show your maximum buying power. So we do our pre-qualification letters a little differently. Some lenders like to do it where it's property specific. We issue you a blanket pre-qualification letter based off of your bank statements, what your maximum buying power is going to be. So we give you a good idea of how big your portfolio can one day be, basically, is what your pre-qualification letter shows. It'll also show an example set of terms. As you guys will see later on in this presentation, we have a variety of different financing packages with different terms, and so we can get really creative with a lot of our different loan structures, and so we put a range of terms on the pre-qualification letter that you can use to start running your numbers. In terms of actually using the pre-qualification letter, you've submitted your documents. Within a day or 24 hours, you get back your pre-qualification letter. You can now use that pre-qualification letter to begin placing offers. You give it to your realtor, and then once you get an offer accepted, we'll kick off the actual financing process, or the mortgage processing process. But using the pre-qualification letter, so I mean, if you're working with a realtor, you can give them your pre-qualification letter. They now have an idea of the things that you can afford. You can start placing offers yourself. You know, depending on the bank statements, the amount of liquidity that you showcased on your pre-qualification letter, you could be waving around a lot of buying power, and so you can use that to connect with different realtors. And if you aren't working with a realtor, you can ask your loan officer for a referral. We're in a number of different markets across the country in at least 25 or 30 different states. So you can ask for referral. We have pocket realtors in the same way that a lot of realtors have pocket listings. We like to say we have pocket realtors. So, beyond issuing any sort of referral, we can connect you with a realtor, explain to them what your buy box is going to be, and hopefully they can help you get a deal. Again, you need to have a pre-qualification letter at that point so that the realtor knows you're ready to move on things. So after getting an offer accepted, you're going to send it over to our deals inbox. That's deals@munoz.ltd. It'll automatically reply with your loan application, and boom, we can get right into it. So we have a super automated process. If for some reason this is glitching, and sometimes from time to time it does glitch, you can actually just go on our website, and there's a gold button under our syndicated DSCR section. Under services, there's a gold submit deal button, so you can just go there, click submit, and boom, you can get started with your loan application. And that's what you do once you get an offer. So at this point, you guys have submitted a deal. Alright, so there's 2 ways to submit a deal. We talked about sending it to the deals inbox, clicking on the gold submitted deal button on our website. And so now we're getting into the fun part of DSCR loans, which is the processing cycle. So you guys now know what a DSCR loan is. What does DSCR mean? How to use that ratio to do underwriting for your own deals. What documents you need to get a loan approval through us. How to submit a deal. How to get a pre-qualification letter. So let's now talk about the processing cycle. So of course we're going to start off with a loan application. We do use standard 1003s. It's completely online. It's a beautiful process. It's really quick, really smooth. It's nice and simple. It's clean. You can get through it in about 5 or 10 minutes max. You submit that. You get that loan application after submitting that purchase contract, and boom, you get that loan application. You can work through it in 5 or 10 minutes. That's going to be the first step of the loan processing timeline. So like I said, you instantly get that after sending us a deal. It's going to auto-reply with a loan application. You complete that loan application, and then you get into your portal. So we have a portal where you submit your documents that we talked about. Those are mainly going to be your LLC documents and bank statements. Maybe if your realtor is corresponding a little slowly, you might have to send us a copy of your purchase contract, but we really can only begin to process a loan on our end and assign it to somebody on our team until you complete a loan application. So we really want to make sure that that's completed as quickly as possible. After that, we're going to go into a doc collection process. So once you complete the loan application and submit the initial documentation, you're going to get a set of disclosures. You just have to acknowledge and sign them as we proceed and go through it. So at that point, you're going to get a link to pay for your appraisal, a link to pay for your credit report, and any insurance quote. We do own an insurance company in-house, and so we can refer you always over to an insurance company and an agent that you can get a quote from. You don't have to work with our company, but you can just use that quote as a baseline to shop around with. So you've submitted your initial documents. We're starting to correspond with your realtor. You'll see that one of the documents actually that we need, we'll talk with your realtor if you don't know who the best point of contact is going to be, but one of the things that you're going to have to help us out with during the process, and that's just because we don't know most of the time, like I said, unless we're going to be talking with your realtor, is who that title company is going to be. So you guys saw during the document portion of the initial presentation how many title documents we need to collect. There's a big emphasis on third-party cooperation here. So again, your realtor, the title company, and any appraiser documentation that we need is going to play a huge part in getting DSCR loans approved. So there's a big emphasis on third parties. So we ordered that appraisal. We're getting those documents from your title company, and that's a lot of the times where the majority of, 50% of the deal kind of happens. So we get that loan application, we get all your documents, and that's week 1. Beginning of week 2, we're ordering your appraisal, talking with title company, etc. And so depending on how long that appraisal kind of takes to come back in, about a week or so. That's the middle portion of the transaction going into the beginning of week 3. Right after that, once we have the entire packet of documents that we need, we're going to submit to underwriting. So underwriting and conditional approvals. Like I said, once we get all the documents, we're going to submit it to underwriting. We'll get back a conditional approval. It's going to basically say, what it means is the loan is approved, but we're missing these documents. We have to collect these extra documents from you or from the title company, maybe from the appraiser. We need to get something adjusted on the appraisal report. Once we collect all those things again, then we can resubmit and get a final approval, and that's how we'll get it clear to close. So that's pretty much what happens at this stage. We submit it to underwriting. The underwriter will thoroughly review the loan application, borrower documents, just pretty much make sure everything meets our guidelines. And then after that review, that conditional approval comes out, which basically means the loan is approved, but we have these outstanding items. We'll collect those remaining items and get the loan cleared for closing as quickly as possible. That's going to bring us to our final stage, which is final approval, closing, and funding. Everybody's favorite part of a deal. So once all conditions are satisfied, we're going to get a clear to close, and we're going to go ahead and schedule your closing with your title company.